Most business owners believe profit comes from more sales, more customers, and more hustle. But the truth is something else. In fact, 97% of business owners never become truly profitable because they never build serious business finance habits. In this video, you will learn 5 business finance habits of highly profitable business owners. Habit number 1, cash clock auditing. This habit sounds strange, but it's one of the most powerful cash flow tools used by serious operators. Cash clock auditing means reviewing how fast every dollar returns back to the business after you spend it. Most owners only ask, how much did it cost? Profitable owners ask, how fast does this expense return money? For example, if you spend $500 on ads and customers pay you within 5 days, that's a 5-day cash clock. If you buy inventory that sells after 90 days, that's a 90-day clock. If you pay rent for space that doesn't improve sales for months, that's a dead clock. Once owners start measuring cash clocks, they begin choosing expenses that rotate money faster instead of locking it for months. They negotiate better payment terms, so cash comes in before it goes out. They shift from bulk inventory to smaller rolling inventory. They reduce marketing channels that take forever to convert. Small mindset change. It's not about cheap versus expensive, it's about fast versus slow cash rotation. Businesses with fast cash clocks grow without borrowing. Businesses with slow clocks always depend on loans to survive. This single habit creates stability, cash availability, and real peace of mind. Habit number 2, profit-first pricing filters. Highly profitable business owners never decide pricing based on competitors or industry average. They use something I call profit-first pricing filters. Before they finalize a price, they run that price through a checklist of filters: cost coverage, operating margin, cash flow impact, risk buffer, and customer lifetime value. Most owners only check product cost versus selling price. That's why they end up with razor-thin margins. With profit-first pricing filters, they ask useful questions like, can this price cover future marketing expenses? Can this price handle refunds or replacement risk? Can this price survive discounts or distribution cuts? Can this price support business taxes and debt payments? When a price passes all filters, it produces true profit, not just revenue. Here's the twist. Owners using this habit stop competing on price and start competing on value. They add guarantees, packaging upgrades, speed of delivery, expert advice, or support to justify pricing. This habit also removes emotional guilt from charging higher prices. Instead of, is this too expensive? The question becomes, will this price keep this business healthy long term? That simple filter turns pricing into a business finance tool, not just a marketing decision. Habit number 3, expense to outcome mapping. Most businesses track expenses in spreadsheets and software, but they never connect expenses to outcomes. Expense to outcome mapping means every major expense must point to a measurable business outcome. Not complicated formulas, just simple mapping like expense, outcome, and timeline. For example, paying for software should reduce time or errors within 3 months. Hiring an employee should increase sales, reduce workload, or improve delivery quality within a set timeline. Marketing spending should generate leads or brand equity that converts in a predictable cycle. Owners who practice this habit categorize spending into 3 levels: productive, neutral, and destructive. Productive expenses create sales, speed, accuracy, customer retention, or better margin. Neutral expenses maintain operations without major gain. Destructive expenses slow down cash, create complexity, or burn money without outcome. Once this map exists, decision-making becomes peaceful. Owners stop panicking about expenses because they finally know which ones produce results. This habit prevents bloated expenses, protects cash flow, and brings discipline without becoming cheap. Most importantly, it changes how the team thinks. Everyone starts asking, What outcome will this expense produce, and how soon? That's how real companies scale without breaking their finances. Habit number 4, credit strength stacking. This habit is rarely talked about outside banking circles. Credit strength stacking means intentionally building your business into a strong borrower long before you actually need capital. Highly profitable owners don't wait for emergencies to apply for loans. They prepare years in advance by stacking credit signals that banks and investors love. Clean bookkeeping, stable cash flow, low utilization, strong debt service coverage ratio, tax filings, and supplier payment history. Why does this matter? Because capital flows to companies that look safe. Owners with weak credit are forced to borrow at high interest or get rejected during serious opportunities. With credit strength stacking, the business builds multiple forms of capital access: bank credit lines, vendor credit, business credit cards, equipment financing, invoice factoring, and investor confidence. This doesn't mean using debt recklessly. It means having options. During recessions, slow seasons, or expansion phases, companies with access to capital grow while others freeze. When a competitor shuts down, credit-strong companies acquire assets cheaply. When a big order comes, they fulfill it without rejecting revenue. It's not about borrowing today, it's about proving you can borrow tomorrow. This single habit is the difference between survival and strategic growth in the real world of business finance. Habit number 5, forward-facing profit windows. The final habit is incredibly powerful and almost never taught in traditional advice. Forward-facing profit windows means looking at your future profit 3 to 6 months ahead, not just analyzing last month's reports. Most owners only check past performance, like revenue, gross margin, and expenses from 30 days ago. By the time they realize something went wrong, it's already late. Businesses using forward-facing profit windows build projections for sales, expenses, inventory, labor, taxes, and debt. These projections don't need to be perfect, they just need to be directionally correct. For example, if seasonal slowdown is coming in 90 days, you cut expenses now. If a big project will require more cash in 60 days, you prepare credit or push deposits today. If taxes will hit next quarter, you reserve cash instead of spending casually. This habit makes profit intentional, not accidental. Owners become proactive instead of reactive. They stop being surprised by payroll, tax season, renewals, or dry sales months. Forward-facing profit windows give psychological confidence. Instead of worrying about money every day, owners finally see the road ahead. That's how real companies stay profitable for decades, not just lucky for a few months.